Morning. I observed something I've monitored closely for over a decade finally emerge into view. Silver has now surpassed $100 per ounce, not $99.95 with some minor adjustment or rounding. Exactly $100 appeared on the display at 11:10 a.m. Eastern Time today, January 23rd, 2026. The $100 barrier. Welcome back to Marked on Smart DeFi Nation. If you're tuned into financial news channels at the moment, the term volatility gets repeated roughly 40 times every segment. You hear talk of retail frenzy, parallels to GameStop, meme assets, and every overhyped irrational excitement tale recycled since the Dutch tulip craze. But here's what they're completely omitting. The storage facilities are depleted. Over 10 years, I've studied real-world commodity trading, accumulating holdings in silver during its $20, $30 range, observing the derivative tricks unfold repeatedly in futures trading floors. I've witnessed suppression tactics. I've seen organized bearish pressures. I've noticed failed deliveries hidden in exchange footnotes. Yet what I'm witnessing today isn't merely an intense short squeeze. It's a fundamental rupture in the worldwide valuation framework for actual silver. Mainstream outlets fixate on screen charts. I'm tracking the freight vessels. I'm examining withdrawal requests. I'm checking the Shanghai Gold Exchange, where silver currently quotes at $111.67, $11.55 above New York's benchmark level. That $11 difference isn't random inefficiency. It's the noise of the Western valuation apparatus collapsing live. And the developments on those ships, the patterns in withdrawal documents, the activity throughout Asian physical arenas, they completely alter how this chapter concludes. Because the surge isn't fueled by enthusiasm for silver. The surge stems from attempting to purchase and receive tangible metal, only to discover it's unavailable. Let me state this plainly. This isn't a typical upswing. This isn't a bullish wave or crowd excitement driving a trendy play. This represents an outright physical withdrawal from Western silver supplies that has shattered the derivative-based pricing structure. For half a century, silver valuation has relied on agreements traded in New York and London, futures, options, enormous paper commitments far exceeding available deliverable quantities. The arrangement functioned since most positions never turned into actual bars. Traders exchanged contracts, closed in cash, leaving the real market calm in the shadows. That arrangement has now ended. We're observing a clear separation between Eastern and Western systems. The Shanghai Gold Exchange quotes silver at a substantial markup versus COMEX. The LBMA struggles to justify vanishing physical bars from reserves. Withdrawal requests on COMEX this month run about 5 times higher than January last year. The New York paper benchmark is being overridden by real demand in Shanghai. The resulting arbitrage window is enormous, so every unsecured ounce gets swiftly pulled from Western storage and redirected eastward. The price-finding process that ruled silver for decades no longer operates. The displayed spot level grows increasingly detached from the true cost of obtaining and transporting physical metal. We're witnessing one of the most significant commodity disruptions in recent decades. The derivative shorts, bullion institutions, carrying heavy bearish exposure for years, now face a roughly $390 billion obligation they cannot fulfill. Not through paper maneuvers or cash tricks, in genuine physical form. I'll outline the precise calculations showing how arbitrage-fueled backwardation triggered an irreversible physical outflow. I'll explain why those bullion houses are cornered without an easy escape. I'll present the withdrawal statistics proving this goes beyond mere speculation. It's actively underway. Let's lock in the current picture. At 11:10 a.m. Eastern today, benchmark silver reached $112 per ounce, a 3.29% daily jump. Gold stood at $4,166.46. Calculate the ratio. Gold divided by silver yields about 49.6 to 1. That figure should make you pause. The long-term average gold-silver ratio hovers near 80.1. Over the past decade, it mostly ranged 70-90. In March 2020, amid the pandemic scare, it briefly hit around 120.1. 49.6.1 isn't gradual drift. It's silver advancing much quicker than gold. The market is revaluing silver not as an industrial side product or speculative plaything, but as a monetary asset in genuine scarcity. But the real cracks appear here. Check the Shanghai Gold Exchange right now. Silver at $111.67. That's the $11.55 markup. In China, tangible silver trades roughly 11% above New York's spot. Consider that carefully for a moment. Buy on COMEX near $100, take receipt, transport to Shanghai, sell near $111. You pocket an 11% gain on a deal spanning perhaps 2 weeks. Risk-free arbitrage like that shouldn't persist in healthy systems. Normally, high-speed desks erase such gaps within minutes. The fact this disparity has lingered for weeks signals something is deeply flawed. The flaw is straightforward. Insufficient physical silver remains in Western hands to eliminate the difference. The metal has already departed. Review Shanghai Futures Exchange stockpiles. roughly 581 metric tons remain, about 18.6 million ounces. Months ago, that figure exceeded 1,000 tons. It's depleting rapidly, with every ounce exiting replaced by shipments from London and New York. Now consider withdrawal notices. I reviewed COMEX figures this morning. For January 2026, 8,263 contracts stand for delivery. Each covers 5,000 ounces, totaling roughly 41.3 million ounces that longs insist on receiving physically this month. 44 million ounces demanded in a single month. Bank of America posted 233 notices. JP Morgan issued 156. These aren't minor participants. They're the dominant bullion players guiding this arena for decades. They're juggling metal they lack in secure storage. COMEX holds around 150 million ounces total inventory. Only a portion is registered, meaning truly ready for handover. If even 10% more contracts opt for delivery rather than rolling or cash closing, registered stocks reach zero. Zero, as in the exchange, exhausts deliverable silver against futures. Here's the question everyone avoids. Why doesn't COMEX simply lift prices to align with Shanghai? Why not allow silver to trade at $110 or $120, whatever balances supply versus demand? Because that activates the fatal snare, and the institutions understand it. Arbitrage-propelled backwardation. Let me clarify the mechanism fueling this entire situation. Backwardation occurs when immediate price exceeds future price. In typical commodity setups, later delivery costs more due to storage, insurance, and holding expenses. That's contango. But during real scarcity, the curve inverts. Buyers pay more now than for delivery months ahead because they require it urgently and doubt future availability. Now layer in arbitrage, and the trap closes. Picture two shops. Shop A offers phones at $500. Shop B buys them at $700. What follows? Every phone in Shop A vanishes quickly, resold to Shop B. Shop A's stock empties fast. The only fix is Shop A raising prices to match Shop B. But if Shop A is bound by agreements to sell at $500, it's stuck. It either violates terms or bankrupts itself delivering. That's COMEX currently. Shop A, Zurich, New York. Shop B, Chicago, Shanghai. The $11 markup drives the arbitrage, and physical silver flows out of Western reserves to exploit it. Here's why the institutions are cornered. COMEX relies on paper volume. Most futures never convert to physical handover. Traders roll, cash settle, or offset. The whole framework rests on one premise. Only a tiny fraction of buyers ever request metal. But with an $11 Shanghai arbitrage, everyone seeks the tangible asset. Positions that once rolled now stand for delivery. The derivative play morphs into a physical fulfillment emergency. If COMEX lifts prices to narrow the gap, say silver hits 115 in New York, the bearish side of every contract suffers massive losses. Institutions with billions in short exposure face margin demands they can't satisfy. If COMEX suppresses prices to shield shorts, the physical outflow persists. Eventually reserves vanish and the system breaks. No neutral path exists. This arbitrage forces a binary result. Either shorts collapse under rising values, or the exchange depletes deliverable stock. The institutions now grasp they're shorting a non-existent paper market. Translate that to figures. Major bullion houses, JP Morgan, Bank of America, HSBC, Scotia, have maintained concentrated bearish futures positions for years. We know from CFTC reports, legal cases, settlements, and long-standing commodities knowledge. Exact scale is hidden across futures, options, swaps, OTC deals. But estimates from open interest and past data suggest at $100 per ounce, potential bearish obligation, if all demanded physical, reaches around $390 billion. $390 billion isn't something casually closed. It's not a quarterly earnings hit. It's potentially catastrophic for holders on the losing side. Compared to real availability, COMEX totals 150 million ounces inventory, worth about $15 billion at $100. The full COMEX system covers under 4% of estimated short exposure. LBMA vaults hold more, perhaps 1 billion ounces total, worth roughly $100 billion now. Still, only about 25% of the bearish commitment. The mismatch is stark. 44 million ounces already standing for delivery this month on COMEX alone. If that rate holds, and the Shanghai markup provides no incentive to slow, annual demand could approach 500 million ounces. COMEX lacks it. London lacks it. Shanghai is depleting too. So where does the supply originate? It doesn't. That's the core reality. Deliverable metal simply isn't there. Another fracture shows in the SLV ETF, the iShares Silver Trust. It's designed to mirror benchmark, holding real metal backing shares. This morning, SLV traded at $90.71, while spot sat at $112, a gap exceeding $9, nearly 10%. Why? SLV is derivative-based, a claim on silver, not silver itself. As tangible scarcity worsens, markets price in the danger that paper entitlements may not be fulfilled as expected. If the world's biggest silver ETF deviates 10% from benchmark, what does it reveal about paper market reliability? It shows the paper framework is fracturing. Tracking is failing. The system allowing silver trading without physical contact is buckling under genuine delivery pressure. Quick summary of the situation: silver at 100 plus, 1155, China premium, withdrawal notices 5 times prior year, $390 billion bearish exposure versus maybe $15 billion COMEX inventory pretending to cover. The pressure isn't approaching, it's active now. The sole uncertainty is how institutions intend to escape. The vertical surge critique. Let me address doubters briefly, or they'll label this blind optimism ignoring facts. Their view, silver climbed from $31 to $100 in roughly a year, over 220% gain. Steep parabolic trajectory. Every technical pattern warns steep climbs finish in sharp drops. This is speculation-fueled hype and fear of missing out. When it bursts, silver holders suffer heavily. On appearance, reasonable point. Here's the counter. Steep rises in fiat assets are manias. Steep rises in tulips, tech shares, real estate stem from borrowed excess, collapsing when underlying lacks solid value or supply floods in. But steep rises in tangible commodities amid scarcity aren't manias. They're adjustments. They're markets finally aligning to truth after prolonged artificial restraint. For 50 years, silver traded in illogical bands relative to industrial needs, monetary heritage, and limited supply. Values stayed suppressed because derivative markets manufactured unlimited apparent supply via contracts rarely fulfilled. Now that derivative structure crumbles, valuation no longer depends on contract volume in New York. It's dictated by existing physical quantities and locations. This isn't excitement. This isn't crowd frenzy. This is correction of decades-long artificial price control. Skeptics also err, assuming higher values instantly boost supply. They argue mining firms will surge output at $100 and oversupply the market. Silver doesn't function that way. Roughly 70% emerges as byproduct from copper, lead, zinc extraction. You can't simply boost silver without ramping primary metals. Even primary silver mines require years: exploration, approvals, building, environmental checks. By the time new volume arrives meaningfully, this crisis phase has passed. Plus, industrial silver use stays rigid short-term. Solar producers can't halt silver consumption over price jumps. EV makers can't redesign circuits quickly. Silver embeds in supply chains, needing years to adjust. So when values spike, industrial buyers rush. They stockpile. They secure contracts at nearly any cost, halting output costs far more. Examine solar sector now. Panel output stalls as firms scramble for silver at elevated levels. That's not retail excitement, that's industrial urgency. It forms a reinforcing cycle, driving values higher. Doubters label it mania until forced to concede it was genuine scarcity all along. Now, future moves. Regulators and exchanges hold one remaining tool: rule alterations. CME Group, overseeing COMEX, already increased margin demands 47% on January 7th. Higher margins force leverage participants to add cash or exit. That hike aimed to remove fragile positions. It failed. Silver continued rising. Withdrawals persisted. So I'm monitoring for another margin increase this month, perhaps doubling or tripling again, triggering forced exits. Leveraged buyers get expelled. Values drop sharply as traders meet calls. This tactic attempts to halt squeezes. Mid-game rule shifts make positions costly, allowing only major players to stay. If you're a smaller futures holder on margin, you're the objective. They aim to clear you, so institutions cover shorts without silver reaching $150. I'm also hearing, stressing these remain unconfirmed rumors, not verified facts, discussion of force majeure announcement. In commodities, it's the extreme measure. Exchange declares inability to deliver, forces cash settlement at chosen level. If enacted, longs receive arbitrary payout, likely under current benchmark, and metal stays put. Shorts get saved. Paper system survives. I've caught murmurs of hidden Federal Reserve liquidity lines to bullion houses, emergency funding preventing collapses at JP Morgan, Bank of America under short pressure. True, but unknown. I'm not in those decision rooms. But I recognize historical patterns. When markets threaten establishment interests, rules bend to safeguard large players. So here's my focus: Shanghai Gold Exchange markup. If that $11 gap holds above $10, physical outflow continues regardless of COMEX actions. Margin increases, force majeure, cash settlements, none halt metal moving where valued highest. The SGE markup reveals truth. Everything else is distraction. Media reaction ahead. Over coming weeks, expect unified messaging, heavy focus on volatility, cautions to retail about risky gambling, experts declaring bubble. Absent will be physical markup coverage, withdrawal stats, Shanghai arbitrage explanation. Why? Widespread awareness would empty remaining Western reserves overnight. Institutional strategy is clear. Frighten average holders away while large capital quietly accumulates. Make everyday investors doubt silver ownership, while banks discreetly close shorts at necessary levels. Resist that narrative. Track data. Monitor withdrawals. Watch Shanghai spread. If spread remains wide, pressure persists. What this isn't. Before sharing my personal approach, one vital clarification outweighs any statistic or forecast. Nothing here constitutes financial guidance. Not a single phrase, figure, or tactic. I'm not licensed advisor. I hold no credentials. I manage no external funds, no clients. I examine commodity patterns for my own holdings and share findings openly because information imbalance in these markets is massive, and people deserve visibility into hidden dynamics. But that doesn't qualify me to direct your capital decisions. When I describe my approach, triggers, positioning, those reflect my personal tolerance, timeline, finances, conviction. None automatically apply to you. Your responsibilities differ. You may require cash soon. You may trade leveraged. You may plan decades ahead for retirement. Reevaluate then. While wide, I maintain. Trigger 2. Third margin increase this month. CME hiked January 7th. Another rise, doubling, tripling, likely sparks forced selling. Leveraged longs exit. Sharp downward spike as calls met. I won't liquidate into that. Stay composed. Allow fragile positions clear. Then observe if physical demand rebounds. Margin changes don't resolve scarcity. They filter participants. Third hike plus 15-20% daily drop. No panic. Exchange defending shorts via paper pressure. Physical reasserts soon after. Conditional step. Silver closes weak above $100. 5:00 p.m. Eastern Friday. I adjust stops to $92 range. 8% buffer protects capital while remaining exposed. $90 below $100 psychological floor, yet above prior breakout level. Below $90 after $100 hold signals change. Markup collapse, industrial drop, intervention. Take 8% loss, reevaluate. Better than full reversal ride. But I'm 100 plus through January end. Position untouched. Breakout validated. Next zone 125. Extreme scenario. Force majeure or cash settlement notice from LBMA Comex. I shift fully to physical immediately. Broken system. Trust touchable assets. Paper worthless. If exchange voids delivery, cash settlement confirms paper death. Exit ETFs futures, enter bars, coins only, premium, liquidity secondary. Priority, real metal, immune to rehypothecation or ledger swaps, my boundary. System admits non-delivery. I exit paper entirely. What I avoid, chasing highs. No FOMO purchases at $100, fearing $150 tomorrow. Build holdings gradually in 30s, 40s. Late entry needs volatility ready plan. Also not trimming core. $120, then $80 reversal? Irrelevant. Thesis isn't short-term swing. Thesis is multi-year structural deficit. Final element, 20% cash reserve, not crash anticipation, but opportunity capture. Forced exits, margin spikes, 20% daily drops. Dry powder allows addition. Worst in turbulence, fully committed, no flexibility. Cash creates choices. Act opportunistically, not reactively. That's my framework, not guidance. Fits my tolerance, horizon, belief. Physical silver shortage begins multi-year phase. You require your own, tailored to you. But reject mainstream bubble pop narrative. Honest repricing returns full circle, $100 crossed. Shanghai massive markup. Record withdrawals. Comex reserves draining. Bullion houses face $390 billion short burden. No smooth cover. This isn't meme-driven, not retail craze, not bubble. It's market aligning silver to physical truth, not derivative games. Half-century price set by contract volume on exchanges. Supply seemed unlimited. Digital entries, short millions without owning. As long as margin met, ignored, game finished, physical forces return. New York-Shanghai arbitrage drives unstoppable west to east flow. Paper shorts trapped, unwind blows them apart. This is honest valuation. Turbulent, disruptive, painful for old beneficiaries, but unavoidable. Scarce asset suppression can't last forever. Physical reality prevails. We're seeing major commodities, wealth shift in modern times. Those grasping physical deficit and positioning benefit greatly. Paper-leveraged institutions face destruction. Question: how long can delay tactics persist? Margin hikes, rule shifts, media volatility focus, ignoring delivery crisis? Estimate, not long. Shanghai markup empowered warning signal. While elevated, outflow continues. Comex exhausts deliverable. Paper price irrelevant. Silver trades at real buyer willingness. Asia suggests far above $100. Final note, beyond profits or trade accuracy, this concerns market honesty, whether discovery reflects true supply, demand, or bank leverage capacity. Decades, leverage dominated, banks set prices via derivatives, physical secondary, now reversed. Physical overtakes paper. Those mocking silver accumulators as theorists now see, they were simply ahead. Events accelerate beyond news grasp. By mainstream, full recognition, opportunity vanishes, metal secured, values multiples higher. For background on $390 billion short, mechanics, prior suppression, review my earlier breakdown. Covers history, CFTC data, legal cases, imbalances making this unavoidable. Provides full context, not mere squeeze. 50-year pricing regime collapse. Watch that for banker short details, margin call effects. $100 threshold isn't peak, it's repricing start. You may hold opposing views. Those variances hugely impact real choices. So if I mention holding during swings or watching signals, I'm not instructing you. I show one experienced view navigating conditions. That's insight. That's framework sharing. That's not directive. Why this emphasis? Silver market volatility is extreme now. 5%, 10%, 15% daily shifts common. Margins fluctuate. Withdrawal patterns evolve. Geopolitics intervenes. Industrial needs shift. Policy changes suddenly. Any exposure carries serious hazard. Loss is possible. Heavy loss is possible. Total wipeout possible, if leveraged and margin called. I can't assess your risk capacity. I can't judge silver's fit in your allocation. I can't confirm you grasp distinctions between physical, ETFs, futures. Those you must resolve, ideally consulting licensed experts familiar with your full picture. My role: deliver data, clarify mechanics, highlight overlooked elements like delivery notices, Shanghai markups, inventory drops. Information mainstream often skips, but information guidance, breakdown directive. Perspective strategy. You construct your own framework around your reality. You determine silver's place, if any. You set allocation size. You evaluate volatility tolerance, counterparty exposure, regulatory unknowns. Those choices belong to you. Another key: I could misread everything. Shanghai markup could vanish tomorrow. Industrial appetite could collapse. Fed could reveal massive support, rescuing bullion houses and tanking values. Major find could reshape supply. Markets are intricate, evolving networks with countless factors. I can't capture them all. My view draws from best available public sources and 12-year pattern recognition. But no flawless vision or prediction. I've erred before, I'll err again. Absolute certainty in markets signals deception or illusion. So when I reference $390 billion short burden, structural scarcity, arbitrage backwardation, view them as interpretive lenses organizing messy data. Models simplify. They assist. They can mislead. Map terrain. Thesis result. Analysis certainty. This grows crucial discussing geopolitical regulatory threats. Force majeure. Fed moves. Margin jumps. Real extreme risks altering outcomes. I lack insider details on regulator intentions. No access to CME, Fed, Treasury private talks. I interpret public signals like you, inferring from past examples. If you plan assuming no intervention, then face one, you suffer. That's market reality, not my responsibility. Regulated arenas allow swift rule shifts. Account for extremes in position sizing, risk controls. Have exit routes. Define acceptable loss before acting. That's fundamental risk handling, not guidance. One final note. Preferring physical over paper claims reflects my personal counterparty worries in potential force majeure cases. Doesn't mean physical suits. All physical involves expenses, risks, storage, insurance, buy-sell spreads, lower liquidity versus instant ETF sales. Trade-offs depend on your needs. Absolute ownership certainty worth inconvenience. Physical fits. Need speed, liquidity, active trading. ETF better despite counterparty risk. No one size fits all, only what aligns with you. As I describe my personal strategy, treat it as example study. This reflects one individual's assumptions and limits. May not suit you. Don't replicate. Don't copy triggers. Don't assume my holding through turbulence means you should. Form your plan. Research independently. Seek qualified advice tailored to your finances. This content educates and informs. It's commodity analysis during high stress, not investment blueprint. Not buy, sell, hold directive. Clear? Good. Last thing desired is someone risking unaffordable capital thinking I recommended it. I didn't. I'm detailing my actions and reasoning. Your response is yours alone. My personal approach. Now my current positioning, again, not guidance. Sharing 12-year market participants plan. Trigger 1. Shanghai Gold Exchange markup under constant watch. Spread above $10 per ounce. I disregard COMEX dips. Pull back to $95 or $90 irrelevant. 10 plus arbitrage window means physical outflow continues. Correction brief. Scarcity enduring. If markup shrinks below 5 oscillators, situation shifts. Flow eased. Perhaps Eastern demand met or convergence occurred.